29% of the people using Buy Now, Pay Later just finance their groceries. Not a couch, not a laptop, a bag of groceries, paid off in 4 installments. And 2 years ago, that number was 14. So half of a whole industry now runs on people who cannot cover a cart of food in one go. Here is the part that should stop you. It feels free. 0 interest, no credit check you can feel, a little button at checkout that says Pay in 4, and the pain just disappears. So where's the catch? The catch is not the interest. There barely is any. The catch is that this is subprime lending wearing a hoodie. Same risky borrowers, same repackaged risk as 2008. It just swapped the suit and the paperwork for a friendly logo and a checkout button. And a Federal Reserve governor just called it, in public, a debt trap. So that is what this whole video is about. How did the riskiest kind of lending put on a hoodie and become the most popular button on the internet? Stick around for the number nobody is allowed to see. That one is the whole game. Let me show you the trick. Start with how it actually works. You are checking out $60 of stuff. Instead of paying $60, you pay $15 now, and 3 more payments of $15 every 2 weeks. 6 weeks, 4 slices, and to you, it costs nothing extra. Klarna, Affirm, Afterpay. That is the pitch, and it is genuinely clever. So how does the company make money if you pay no interest? The store pays. A credit card charges a shop about 2 to 3%. These companies charge the merchant 5 to 8. Source on that is the Federal Reserve itself. And the store pays it gladly. Because when you can slice the price into 4, you buy more. Estimates say the little Pay in 4 button lifts sales 20 to 30% and pushes the size of the average order up even more. You feel richer. You spend like it. The store wins, the lender wins. Which raises the obvious question. If everyone is winning, who is losing? To answer that, you have to look at who is actually pressing the button. And this is where the hoodie comes off. The government pulled the loan data. The Consumer Financial Protection Bureau found that most of this lending goes to people with damaged credit. Deep subprime borrowers were 45% of the loans. Another 16% were subprime. So roughly 6 in 10 of these loans go to the people a bank would think twice about. And the approval rate for those subprime applicants? 78%. They say yes to almost everyone. The Federal Reserve went further. It found that people with credit scores under 620 use this stuff about 3 times more than people with good credit. The users carry more than 3 times as many already late accounts. 35% of people who have maxed out their credit cards reach for Buy Now, Pay Later. 40% of people already using payday-style loans use it too. So picture that customer. Cards already full, a payday loan running, late notices in the drawer. And here is a new door that opens. No hard credit check and says, sure, 4 easy payments. That is not a shopping tool. That is a pressure valve. And the Fed put a name on it that I cannot stop thinking about. They ran a survey and titled the report with the user's own words. 55% said they used Buy Now, Pay Later because it was, quote, the only way I could afford it. Among the people just barely getting by, that number was 78%. The only way I could afford it. That is not a feature, that is a confession. So now you know who is holding this debt, the most stretched people in the economy. Which brings us to the number nobody is allowed to see. Here is what makes this different from a credit card, and worse. When you run up a card, the bank tells the credit bureaus. It shows up. A mortgage lender can see it. A car dealer can see it. Buy Now, Pay Later mostly does not report anything. Most of these Pay in 4 loans never touch your credit file. No hard check going in, no record coming out. The CFPB says it plainly. Because lenders do not furnish the information, these loans, quote, remain unobserved in credit records. They are invisible. And it goes higher than your mortgage lender. The Federal Reserve, the people whose entire job is tracking how much Americans owe, admit in writing that their main consumer credit report is, quote, not currently able to separately track this lending. The official National Debt Scoreboard, the one that says households owe $18.5 trillion, Buy Now, Pay Later is not even in it. An economist at Wells Fargo gave it the perfect name. He called it phantom debt. Real money, real people on the hook, but a ghost to everyone keeping score. He warned that the experts had been, quote, lulled into complacency because the thing they were measuring was missing a giant piece. Now, you might have heard this is getting fixed, that the credit companies are finally cracking down. Sort of. In early 2025, Affirm started reporting its loans, and the score makers built a new formula that counts them. Progress. Except the new formula is not the one your mortgage lender actually uses. And the two biggest players, Klarna and Afterpay, still refuse to hand over their pay-in-4 data at all. Klarna's excuse? That the credit system does not, quote, reflect how their product is used. Translation: the ghost is still a ghost. They just issued a press release about it. Now, watch what invisibility does to human behavior. Because no single company can see the loans you have with the other companies, you can stack them. And people do. The CFPB found 63% of borrowers had more than one of these loans running at the same time. A third of them were borrowing from multiple different apps at once. So somebody can be 3, 4, 5 payment plans deep across 4 different logos, and not one of those lenders knows about the others. On paper, to a bank, that person looks totally clean. In reality, every other Friday, 4 separate auto payments fire out of a checking account that is already thin. And here is the quiet cruelty in the plumbing. When one of those auto payments bounces, the system does not just try once. The CFPB found a failed payment can get retried up to 8 times. 8 swings at an empty account. And every miss can trigger an overdraft fee from your own bank. Buy now, pay later users overdraft their accounts about 2.5 times as often as everyone else. So the free thing quietly manufactures fees somewhere else, just not on the invoice you were looking at. Before we get to how this ends, one thing everyone gets wrong. People hear all this and say, okay, so the delinquency numbers must be exploding. And that is the trap, because they are not. Right now, the reported losses look great. The charge-off rate on these loans actually fell to under 2%. The companies will show you a slide where everything is calm and green. And that is the single most 2007 thing about this entire story. Because that is exactly what subprime mortgages looked like, right up until they didn't. Contained, low losses, everything fine on the dashboard. The danger was never in the numbers you could see. It was in who was holding the debt and whether anyone could measure it. And on both of those, this is worse. The borrowers are more fragile, and the debt is a ghost. So where is the smoke if the fire is hidden? You look at what people are financing and whether they are keeping up. On both, the story is turning. Remember the groceries? 29% doubled in 2 years. When people start financing the stuff that is gone in a week, food, takeout, that is not convenience. That is a cash flow emergency with a checkout button. There was a perfect moment for this. In early 2025, DoorDash teamed up with Klarna so you could pay for your dinner delivery in 4 installments. The internet lost it. Jokes about the repo man coming for your burrito. And a DoorDash executive tried to calm everyone down by explaining, and I promise this is a real quote, that you did not need buy now, pay later for a burrito, you needed it for, quote, an AirPod, a TV. Sir, you built the burrito button. And the keeping up part? Slipping. The share of these users who paid late climbed to 47% this past year, up from 34% just 2 years ago. 43% say they regret a purchase they financed. And over half now say they need these loans just to make ends meet. Meanwhile, the risk is quietly being sold off. These loans get bundled up and sold to big investors, the exact same financial machine that packaged up subprime mortgages last time. Affirm has sold over $10 billion of this debt as securities. Klarna just lined up a $6.5 billion deal to fund more of it. Private credit funds bought roughly $136 billion of consumer loans in a single year, about 14 times what they bought the year before. And the warning shot already fired. When Klarna reported one recent quarter, it had swung to a $95 million loss because the money it had to set aside for people not paying had roughly doubled. Its stock fell below where it went public. So let me put the whole thing in one frame. The most stretched borrowers in the country, taking loans nobody can see, stacking them across apps that cannot see each other, increasingly to buy groceries, while the risk gets sold to Wall Street, and the loss numbers stay calm enough that everyone gets to keep pretending. That is why a Fed governor finally said the words out loud, debt trap. Not because it breaks the rules, because it followed every one of them, and made the debt disappear from the only place anyone was looking. Buy now, pay later did not invent a new kind of danger. It took the oldest one, lending too much to people who cannot afford it, put it in a hoodie, gave it a clean logo, and turned off the part of the system that was supposed to warn you. It feels like a favor. It is priced like a favor. And for a lot of people, it is quietly becoming the thing that keeps them broke. If you want the next way people lose their money explained before it lands in your life instead of after, subscribe. That is the whole job here. How people lose money so you don't. I'll see you in the next one.